That being said, I have to go to the airport now. I'm late for my flight. All right. Day later, we made it to Spain. I haven't slept, I haven't eaten, I'm jet lagged, but I'm here recording part 2 of our Bid and Brew Equity Long Short series. If you watched the first episode, then you understand how we got through the macro data and landed on an opportunity for the wholesale trade and retail trade sectors. Now, there's a specific connection there for the apparel industry, and that is exactly what we're gonna get into with today's video. So that being said, forget about the view behind me. I can't really enjoy it right now because we're gonna get to work on it. So I'll see you guys there. Welcome back to the desk. As I mentioned earlier, we're gonna be picking our long stock and our short stock within the apparel industry. Now, this outlier picking process has to have a justification behind it, whether it is the narrative, the financials, or anything else we can find about the companies we choose in order to justify putting them together in a long short equity strategy. So that being said, let's get into it and I'll see you in the screen. So here we go, part 2 of our long short equity process. This is, as I mentioned, the stock selection. We're gonna pick the outliers within the apparel industry and find justifications for those outlier positions. Now here I spread all of the apples to apples that I could find in the apparel industry, and I've highlighted a few. So we have On Holding, that's On Running, the brand that I see more and more of when it comes to gyms and other public spaces. I think they are really getting ahead in market share, especially compared to names like Nike and Lululemon, right? Now that's besides the point, but I feel like I should mention that. We have Boot Barn, we have Birkenstock, Lululemon, and Gap. Now, I chose Boot Barn as our short position instead of Lululemon, which is the one I really wanted, and I'll explain why in a little bit. But first, let's get into why I chose On Holding. So we see here for the forward PE, this stock is trading at 34.6 times versus an average of 17 times for the industry. This is where most investors go wrong. They think that an overvaluation means the stock is overextended, too expensive, and overdue for a pullback. While most of the time that is true, there are times like these where hedge fund analysts look for these overvaluations that can be justified. This way they know where the market is willing to bet and why. So this time, I think that On Holding is commanding this premium because of its forward EPS growth projections. So they're looking to grow over 35.7%, which is above the industry's average of 18.3%. Now, is it too much for that growth? Is it priced in? How do we know that? And that is the PEG ratio, so the price to earnings growth ratio. And we see a 1.0 multiple here, which is below the industry's 1.5. What this tells me is that we still have some room for On Holdings to keep moving higher. And I believe that is why the market is also willing to pay a 20.2 times multiple for its book and an 11.5 times for sales, which is of course many multiples above the industry average. So now if we can dig further into the financials, we can really hone into why the market is willing to do this, but we'll get to that in a minute. For now, let's look at Boot Barn, right? So this one also commands a premium as far as the forward PE goes, but I don't see how this can be justified because of the below average earnings growth. So in this case, I think Boot Barn could be one of those stocks that is set up for a reality check, if you will. And I think that that is possible because of the PEG ratio where it's at right now. It's at 1.5 times, and the industry average is right about there. So it's trading at fair value. It's not really overextended, but it does tell me, hey, that below average growth, it's already priced in. And what if tariffs come out the wrong way? What if Boot Barn's audience or consumer demographic starts to pull back a little bit, right? So that wide gap of below average earnings, I think, could be closed down now that it's priced in. And that is why you see an average valuation as well when it comes to price to book, price to sales. So far, that is why I picked Boot Barn. But if you see Lululemon, why I really wanted that stock is because the average growth for the industry is 18%, and they're looking to grow at 8.3%. So, that's not really good. And then you have a discount on the PE ratio, forward PE, for a reason. And I think that's the reason why. So, all that combines for a 1.8 PEG ratio, which is overextended compared to the industry average. Now, while I did want to go short this stock, we spread out that stock against on running. As you can see, our long outlier has been chosen as on, and then short outliers as Lulu and Boot. Everything I just said is explained here as well as far as the multiples go. So, if you want to read this later, I'll make this notion available to you. But essentially, this is what the spread looks like for on running and Lululemon. As you can see over the past quarter, it's already been going higher and higher and higher. So I think I missed the boat on this one, but that doesn't mean we give up. There's still a lot of reasons to look into the wholesale trade, retail trade sectors with a specific connection to apparel. And so far, I'm finding enough evidence in on running to go long this stock. But like I said, we need to justify it further. So here's where the financials come into play. Now, before we get into this, I do want to mention that this is not our entire financial analysis process. This is only the overview, the main themes and bullet points that I want to mention to you that act as evidence for this trade to work forward. So, there's a lot more stuff that goes into this, everything of which we teach inside our flagship program, The Sovereign Trader. You get access to all the Excel models that we used to come up with this idea, how to model the trade up, how to compare the financials, and build the financial models that get you honed in to the evidence that makes a trade doable. Not to mention, you get all the data, all access to our ideas and other alumni ideas as well. So you really get that sense of community. And the best part, I think, is that we hold you by the hand until you succeed. So that being said, let's move on with this idea. So why does on stock rock, right? And, we started with the latest quarterly financials. And here we see a 43% growth in the whole revenue number, right, over the year. So that's pretty bullish, especially in a year, a couple quarters that have had tariff fears, ongoing negotiations, consumer pullbacks, inflation fears as well, uncertainty. So for them to push 43% in the revenue, I think that's pretty good. And then we have something that really caught my attention. We have the DTC increased share. So DTC for On is basically their wholesale operation. So they are moving away from retail into wholesale. And I think that's great because that 38.1% share of total sales is able to boost the overall company's gross profit margin, which management already mentioned. It's getting closer to 60%. Now, On Holding is one of the few companies that can say they have a 60% gross profit margin. I don't know any other that can say this consistently. And of course, that's also going to trickle down into EBITDA, into net income, and earnings per share. So I think we're starting to figure out why the market is willing to overpay for this stock, expecting above average growth. So based on all this information, management is also guiding higher as far as revenue goes for the full year 2025. They see 28% revenue growth. Again, this is above industry average, and it's all going to trickle down more aggressively into earnings because of that higher gross profit margin. So speaking of earnings, right, I do want to mention something that I caught in the income statement, and it's highlighted in the foreign exchange gain. So last year, On Holding had a $76.8 million gain as far as foreign exchange goes. This year, we had a $14.5 million loss. Now, again, this makes sense as the dollar starts to move more aggressively against the Swiss franc, the euro, and other major currencies, right? So On Holding is going to have a lot of volatility when it comes to international sales and the gains that can derive from them. So this is important because it's something that investment bankers would take back as a non-recurring item. So essentially not something that usually happens within the business's core activities. And if you add that 14.5 million loss back, you get essentially a much more aggressive EPS figure. So again, I think this is why the market is willing to overpay, expecting that next quarter earnings might be even more aggressive if this keeps on happening. So last but not least, let's look at the cash flow statement. I caught a big delta here for the change in working capital. So Last year we had a $24.4 million outflow. This year we had 120.3 million won. So where was the change really? And you can see it in the trade receivables. We went from 72 million outflow to 124.7 outflow. And this is essentially more demand backlog, because these are accounts that On Holding has to collect, right? It has to get payments on. So essentially, I believe this is due to the wholesale operation. Wholesale buyers are looking to get things in bulk now and finance them for the next 30, 60, even 90 days. So that big change in trade receivables, I think, is due to big orders when it comes to wholesale customers. Now, if you see the new orders and production in apparel, which is what we caught in the first video, this all starts to line up, right? This all starts to make sense. And I think, again, this is why the market is overpaying for On Holding, because since inventory takes about 60 to 90 days to get cleared and become revenue and earnings, that big change in the backlog that we see right here in the cash flow statement might become sales and earnings by the time the next quarter comes around. So if the market starts to price that in, I think we see a big move in On Holding before the quarter is over. So now we can spread On Holding and Boot Barn against each other and other names that are closer together in the clothing apparel, right? So here, this first screenshot is basically valuations, and you get a basic idea of where the industry is at. Same theme, On Holding commands a premium while Boot Barn trades at a discount. Nothing to see there, but this one I really want to focus on, because you see the difference between the return on invested capital, the ROIC, and the return on equity, ROE. They're pretty much the same, right, for both On Holding and Boot Barn. Yet Boot Barn has a lot more debt in its balance sheet. It has 33%, while On Holdings only has 19%. So this means to me that On Holdings is much more efficient at working with what capital they have now versus Boot Barn, which it's not making that much return on the debt that they have taken on. So if anything, if the Fed cuts rates, I think that On Holdings can take on more debt at a cheaper rate and expand their already efficient operations. And speaking of expansion, we see the capacity rates for Boot Barn is at 110%. So they don't really have that much room to expand, considering that the industry average is 90%. Now, when it comes to On Holdings, they are operating at 90%. So we have a ceiling of about 100, 110, and 120 when we see Crocs, right? So that 20 to 30% increase in capacity means a lot more operations, a lot more earnings, revenues, and expansion in the market share, which we already know is happening when we saw the cash flow statement. So all told, I think we're ready to put this trade on. I think that based on what I've seen, based on everything else that we saw in the financials and what I've read about the company, this commands a premium. This justifies what the market is willing to pay. And lastly, when you look at analyst expectations, we have a 22% upside for On Holdings, while only a 6% upside for Boot Barn, which I think, it's reminiscent to what we already said. The growth is already priced in. You can see it in the multiples. And essentially, when it comes to Wall Street lingo, priced in means downside. So again, another justification for this trade to be put on. And all we have to do now is structure it and time it. So this is what we call the technical analysis of long short, right? There isn't any, but let's just call it that. This is the spread between On Holdings and Boot Barn. So as you can see, those red lines are the second standard deviation, which we already entered, and we can expect a mean reversion behavior here to the black line, which is the mean. That would be going from around the 34-ish area up to the 17-ish, and this would be essentially where we make our profit, right? But that's not all. You can't just say On Holding minus Boot Barn and call it a day and trade that. You need to know how much to buy of A and how much to short of B, and what levels really represent what, and what levels could act as your entry and as your exit. So on your neighborhood friendly thinkorswim platform, you can go to the chart area and you can spread on minus this big number times boot. That is essentially the spread that we are trading. That is the spread that is mean reverting and market neutral. Now, all the statistics we are going to cover in the next video, so don't worry about it if you don't get that yet. But as always, the point is this: we entered around the 40-ish, 46-ish area, and now we are up on this spread altogether. So again, this has become a successful trade so far, but it's not over yet. We still have to wait for those numbers on holding for the next quarter. That being said, don't go anywhere, because you now have to understand what this number means, what that 0.5122 whatever, what does that mean? That is the hedge ratio, and you need to understand what the chances are of this spread coming back to the mean, otherwise known as stationarity. And not to mention, you also have to understand how to get that hedge ratio and what to do when it changes, because we manage our trades once a week. We upload all the data back into Excel and we see where the statistics are going. If they are going in our direction, then we hold on to the trade or even add more capital to it. If the statistics are moving away from us, then we take capital away, or we even cut the trade altogether, even if it's moving in our favor. That is the difference between chart trading, pattern trading, essentially all retail trading, and the way that professionals trade. So stick around, because in the next video, we're gonna cover how to model this trade up, what all the numbers mean, and how to get the right hedge ratio for a mean reversion behavior. More than that, you're gonna get the entry targets, exit targets, stop losses, not based on the chart, but based on actual mathematics. On that note, I'll see you there, and don't forget to sign up for the challenge below.